Hi, welcome to another edition of Flipper's Fun Market Insight. My name is Tom Roseen. Thanks for joining us today. We're going to talk about flows for the week ended December 14th, 2011. You know, ironically, investors heard some great news on December 9th where they found out that the European Union actually got together and agreed to at least have a little bit of fiscal unity in their policies, and that was actually good news for the market. We saw about a 1.4% rise for that week ended on Friday, again on the 9th. However, investors are still very, very cautious about what they're going to be doing with their investments. And in fact, instead, they withdrew about $0.9 billion from the conventional fund business because basically they really had heard some bad news about the European debt issues. And so people were kind of going on again, off again on what's going on. And in addition, also they heard about the Fed. The Fed actually turned around and said, hey, listen, we don't think things are too bad. We're not going to do anything with the rates. We're just going to leave them pat, and we're not going to have a QE3. That disappointed some investors as well. So again, we had people basically sitting on the sidelines and getting ready, I guess, for this long holiday session to come up where there'll be low volatility. Well, let's take a look about where flows actually went. If we take a look at the equity group saw about $1.6 billion in outflow. It's been kind of about the trend we've been seeing for quite some time. Taxable bond funds saw an outflow. This is something that actually has not been usual as of late. We'll talk about that in just a second. They saw about $0.7 billion in outflow. Muni bond funds on the flip side actually saw about $400 million in inflows. That was actually some good numbers. And money market funds saw about $1 billion in inflows as well. So kind of a tale of two cities. We saw some conservative asset classes actually taking in money, while we saw equity and taxable bond funds losing a little bit. People had some interests that they wanted to take care of, and there's probably some holiday shopping and the like, so they didn't pay too much attention. Now, if we take a closer look at equity funds themselves and drill down a little bit deeper, we see that they had a 4.91% negative return. And so that was one of the reasons people were feeling a little bit glum about equity funds. So about $1.6 billion leave the coffers. This is a sixth consecutive week we've seen outflows. However, we've had a little bit a trade-off in where those monies were coming out of. This week we saw domestic equity funds lose about $254 million, while domestic, non-domestic equity funds saw about $1.4 billion in outflows. Ironically, if we take a look, though, at one of the other things that we've been talking about for quite some time, we saw about $440 million in equity income, flows going to equity income funds. This is the 31st consecutive week we've seen flows into this group. So obviously people are paying attention to two things. First of all, they're taking a little bit of risk off their portfolios, but at the same time, they're looking for yield. That's been quite a story. Now, if I include, keep in mind this was with a conventional fund business, but if I include ETFs into this bigger scheme of things, we see that there was about $8.2 billion in outflows if we include equity ETFs. And in particular, where we saw the big outflows was out of SPY, that's a spider S&P 500 ETF, and that had about $7.3 billion in outflows. So again, if we include the ETFs, it was a tale of two cities. Huge outflows out of ETFs. Not quite so huge for equities. Again, outflows, $1.6 billion, but not so huge as we've seen in weeks past. So that brings us to the concept of yield. Let's turn our attention now to fixed income funds. Fixed income funds for the second week in three saw outflows. They saw about $700 million in outflows. They had a negative return, 1.08%. But ironically, you'd think after people are being a little bit scared, they put all their money into safe haven areas. And in fact, we saw money flow. The biggest flow was about $300 million into government mortgage funds. So that is a little conservative play. But on the flip side, the next biggest intake was $200 million into corporate high-yield debt. So a little bit ironic there. But if we take a look at where other monies actually went, it was out of flexible income funds. People, that is, it's got a little bit more volatility in those particular groups, and $687 million, so almost the entire outflow was caused by the flexible funds group. So this is something that we've been doing. We've been looking at where yields have been taking people. Interesting, if we take a look at yields and the story we've been telling as well, municipal debt funds have actually had a phenomenal yield after getting just crushed by Meredith Whitney. Actually, their low NAVs and pretty high returns have been very handsome for yields. So if we take a look at the muni bond funds and what they've done for the week, we see that they had their fourth consecutive upside week. They saw about 0.70% return, quite nice. It's the second consecutive week that we've seen inflows for this group, but we've seen quite a few weeks of inflows as of late, and we saw about $364 million in inflows for this group. National munis made up $297 million of that, and of course the single states made up the remainder. If we take a continued look now at money market funds, we see that they saw about $1 billion in outflow. Not really a lot to write home about, but it's the third week that we've seen the inflows. $1 billion in inflows, but third consecutive week of inflows. We're actually attributing a lot of this to quarter-end, funding, where corporate treasurers have to put money away. There isn't a lot of money that's flowing in and out of the funds right now. Again, we're about 2 or 3 weeks off of the holiday seasons and the like. But that was one of the issues that we wanted to make sure that people knew. We don't know where the trends are. We saw about $2.2 billion going to taxable bond funds. Of that taxable money, institutional investors made up about $1.6 billion of those flows, while the retail investor in the retail accounts made up about $0.6 billion or $600 million in inflows as well. On the flip side, tax-exempt money market funds actually saw some outflows, about $1.2 billion. Well, that kind of wraps it up for us, but really what's going to happen over the next several weeks, we don't know, and usually there's very low volume, so if there's any movement either way, it's usually big up or big down. However, what we do know is that we're taking a look at the European debt as an issue on everybody's mind, and that is certainly causing some concern. And of course, we had PPI come out. It's up about 0.3%. That could be inflationary. People are a little bit concerned about it. It's costing more money to create these goods. And then also on the flip side, we saw industrial production actually slide down 0.2%. This is all for the month of November. And so investors might just sit on their hands wondering what they're going to do for the remainder of the year. And I think that's what's going to happen, is they're going to sit on their hands. Well, we may be back in one more week as well, but if not, what you can do is go ahead and drill down a little bit deeper by going to lipperusfundflows.com, and you guys can find out a little bit more about what's going on in your neck of the woods. If not, you can, again, come back and see us maybe in a week. It's possible that we might have some interruptions because of the holidays and may not be back until the end of the year and actually see you in January. And if that's the case, we'd like to wish you a happy holidays and a safe new year. Thanks for joining us. My name's Tom Roseen, wishing you the best in your wealth planning and creation.